In this video, I will be introducing you to the concept or the taxation of trusts. We will look at what is a trust. Then we will look at the types of trusts for taxation purposes. So what is a trust? A trust is a legal relationship where assets are placed under control of trustees to the advantage of beneficiaries. Trust can be classified into two categories, which is an inter vivos trust. An inter vivos trust is a trust created between living persons, so it's a trust created whilst a person is alive. The second classification or type of classification is a testamentary trust. A testamentary trust is a trust which derives from a valid will of a deceased. So, in simple terms, this is a trust that is created when a person or after a person dies through their creation or through their will. What are the possible reasons for creating a trust? A trust can be created for various reasons, including to protect assets for minor children or beneficiaries, to reduce the amount of estate duty, as well as to protect assets in case of insolvency. Now, how do assets get into a trust? Assets can get into a trust in two ways, either through a sale via an interest-free or low-interest loan by the founder of the trust, or where there's a donation through the very same founder of the trust. Once the assets get into a trust, the trust will generate income, and that income is distributed to the beneficiaries of the trust. So the income could be generated from those assets, or those assets could be sold. So that is the type of income that a trust can generate it once the assets get into the trust. What is a trust for tax purposes? A trust is defined in Section 1 of the Income Tax Act, and it is any trust fund consisting of cash or other assets which are administered and controlled by a person acting in a fiduciary capacity, where such person is appointed under a deed of trust or under the will of a deceased person. That is the definition in terms of Section 1 of the Income Tax Act. Now then, the next question is a trust a taxpayer? Right, if you look at the definition of a person in Section 1 of the Income Tax Act, you will see that that definition is inclusive of a trust. Therefore, a trust is a taxpayer for tax purposes. Now that we have dealt with what is a trust and the classification of trusts, let's look at the types of trusts for tax purposes. So we have an ordinary trust. This is the trust that is not a special trust. We will look at what a special trust is shortly. So an ordinary trust is any trust that is not a special trust for tax purposes. Let's look at what is a special trust then, because this is the second type of trust for tax purposes. A special trust, similar to a trust, is defined in the Income Tax Act in Section 1, and it refers to, firstly, a trust created solely for the benefit of a person with a mental illness or serious physical disability, where such disability incapacitates such a person from earning sufficient income for their maintenance or for managing their own financial affairs. So what does this mean in simple terms? It means it is a trust that is created for a person with a mental illness or a person that cannot or has an incapacity in terms of an insufficient income. A special trust can also be, in terms of the second or paragraph B of that definition, a trust created in terms of the will of a person who is deceased solely for the beneficiaries who are relatives of such deceased person, who are alive on the date of death of such person, where the youngest of those beneficiaries on the last day of the year of assessment is younger than 18 years. In simple terms, what does this mean? In terms of paragraph B of the definition of the special trust, what this means is you have a trust that is created in terms of a person through their will, so that person is deceased, right? And the beneficiaries of that trust are related to the deceased, right? And then the most important criterion that I want to bring your attention to in terms of this specific paragraph is that the youngest of the beneficiaries of that trust must be younger than 18 years. And that is the key definition for the special trust for this paragraph. So there must be relatives, and the youngest of those relatives must be younger than 18 years. Just as a form of recap, remember, a special trust is defined in terms of Section 1 of the Income Tax Act, and it refers to people that have a mental illness or have a serious physical disability. Or the second category of a special trust is where you have a trust created in terms of a will of a deceased person, whereby the beneficiaries of that trust are relatives of the deceased, and the youngest of the beneficiaries is younger than 18 years. And then we had said that an ordinary trust is any trust that is not a special trust. All right. So now let's look at how are these types of trusts taxed in South Africa. So a special trust is taxed in terms of the progressive scale for natural persons, meaning they can be taxed based on the type or the amount of income that is generated, so that can range between 18 to 45%. As a parting shot, it is important to understand the taxation of trust so that we plan accordingly for it and then we are not overwhelmed.